Hendrik, can you use last year's capital loss to offset this year's capital gain?
Yeah, so capital gains is a tricky beast itself. We seem to have a few of these today, super and capital gains. But yes, capital losses can be applied to capital gains. Capital losses are different to the normal loss like we were talking before. So it can only be applied to a capital gain. There is some tax planning that can happen around this to make sure that you are fully utilising the capital losses, making sure that if you're going to have a capital gain in 1 year, you do the loss or you have a loss first and then you have the capital gain.
Yeah, so if someone had 2 investment properties, one was a dog, we're going to lose it at a loss, we're going to sell it at a loss.
Sell that in 1 year and then sell the next one in the next financial year, then you can apply that loss to the capital gain.
Or the same year.
If it happens in the same year, then it's fine. It doesn't need to be one first. But if you're looking at 2 financial years, then definitely sell the asset that's going to generate the loss first. That loss is quarantined until you make a capital gain, and then you can apply the loss off it.
So I always remember a capital loss will go with you to the grave.
Yeah, so make sure you keep really good records. Make sure it's included in your tax return. There's a spot there that it is carried forward.
And so if I had a capital loss of $100,000 this financial year, do I have to mention it ever again? Or if it goes in my tax return now, the ATO will have it flagged in the background in 5 years' time. If I did sell a property for a gain of $100,000, it would just get wiped off.
No, you still need to apply that loss against the capital gain. It does.
So they don't remember it against your ATO.
It does show on your pre-fill report from the tax office, but it isn't
Every year though?
Yeah, I think it does.
Yeah, okay.
I think it does. But it doesn't get automatically applied until maybe somebody reviews the return way down in the future. Who knows when that's going to happen?
Right.
So yes, it shows up on your pre-fill, but you have to then apply it to the gain that's actually made.
So that's important to know. If you do have a loss and you get a bonus at work, 20 grand bonus, and there's a loss there from your investment property that was horrendous, you can't offset the 20 grand bonus because that's income. It's not of capital nature. And a little fun learning fact, if you have a discretionary trust that has assets or investments and there is a loss in that trust, the loss is stuck in the trust. You can't distribute a loss to individual beneficiaries.
No, correct.
Okay, moving right along. Rowan, I've sold some shares this year. CBA held for 25 years. DRP makes establishing a cost base a nightmare. Any advice? Good luck. Next question.
I know. It's these DRPs are really a nightmare.
Gosh.
And this, that's the whole strategy of investing for a lot of people, right? They just keep putting these DRPs in place. So technically you are supposed to keep record of all of these DRPs, whether you get 2 or 3 shares, maybe it's even just 1 share each time there's a dividend. There are some sites that can help you generate this sort of stuff. There's a platform called Sharesies, which provides you with some pretty comprehensive historical data. There is some thresholds depending on investments that you hold as to whether it's free or not.
I think you get 10 holdings for free.
But
it doesn't help when it's 25 years down the track. It's more of a forward planning thing now, isn't it?
Exactly. But, I think when you have shares, part of that is a responsibility to make sure that you keep appropriate records.
So on that, Rowan's had CBA shares held for 25 years. I go out on a limb, there could be significant value there, okay? There could be 300 grand worth of CBA shares. We don't actually know. I'm making a number up. You basically, if Rowan rocked up to your practice and that here we go, it's literally like, okay, well, you've got no records. We'll log into the registry and see what we can find. We have to make some conservative assumptions for the ATO.
Yeah, look, if that happened, first of all, I'd have a little cry because it's like, that's a nightmare.
But
Like
Rowan, because of that, one of my points was there could be a few $1,000s worth of accounting time and fees.
Exactly. But given the value of the shares and the capital gain that's likely to happen, it's really important to make sure that we get the cost base. So even if you were able to provide the initial number of shares purchased and the date the shares were purchased, that is a really good start, because then we can work out what the dividend reinvestment was each time. And work out a very long spreadsheet to be able to update that. Gets a bit more complicated when you are buying and selling throughout the time. But, at least if you have that initial purchase, that's a really good start.
I'm just, for fun, I just brought up ChatGPT, see what they say, right?
Yes.
I
That
purchased,
good old ChatGPT.
That's always wrong. Here's this. How's this, rather? ChatGPT is good, but if you don't know what you're freaking talking about to start with, there's so many mistakes in it. So don't rely on it, people, for stuff. Let it do some heavy lifting, but
then you need to do your research.
Well, you've got to know what you're freaking on about.
Exactly.
I purchased $10,000 CBA shares in Australia in 2000, just sold them. There was DRP along the way. What is the value today if sold, and what is the cost base for because it's after pre-CGT flag anyway, so there's a real one in the boat. What is the cost base for the parcel assuming DRP? We might break the internet now. Let's have a look. And that speaks to why going forward, like, I don't use a direct CHESS-sponsored broker. I use a platform because I just want all the records to be rock solid. All right, here we go. G'day, Glen. You've done well holding on to those CBA shares since 2000, especially with the dividend reinvestment plan. And if you are watching on YouTube, I will share this because we are doing more of a show now for YouTube. And thanks for listening, obviously, if you're on Spotify or Apple. So I've shared ChatGPT. Initial investment, $10,000. CBA share price in 2000, approximately $25 per share. Initial shares purchased, $10,000 by $25 equals 400 shares. Auto switch. Participating in the DRP means that instead of receiving cash dividends, you received additional CBA shares. Over 25 years, this compounding effect can significantly increase your total shareholding. Thank you, Captain Science. While exact figures depend on dividend amounts and share prices at each reinvestment point, historical data suggests that a long-term DRP participants could see their shareholding increase by approximately 2.5 times over 25 years. Estimated total shares in 2025, 400 initial shares times 2.5 is 1,000 shares. Bit of a summary here. CBA share price in May, approximately 175. We're at all-time highs. Total value, 1,000 shares times 175 is $175,000. Calculating the cost base for this CGT, initial purchase cost, $10,000. Cost of DRP shares, it's considered a separate purchase. So the cost base for these shares is that their market value at the time of each dividend reinvestment. Yep, we know that.
Yep.
Accurately calculating the total cost base requires detailed records of each dividend reinvestment.
Did we just say that?
Yep. Including dates and the share price. You've kept these records. You can sum the market values. If you've kept these records, you can sum the market values of shares acquired through DRP to determine or to estimate. Okay. Estimating the capital gain. Total proceeds from sale, $175,000. Let's assume that approximately $40,000, including initial investment and DRP shares. So capital gain equals $175,000 less $40,000 equals $135,000. Note, this is a simplified estimate for precise calculation, especially for tax purposes. purposes, consult with a tax professional or financial advisor. Key takeaways: investment growth. Your $10,000 potentially grew to $175 over 25 years. All that to say, it was useless.
Keep good records.
ChatGPT was basically useless.
Yep.
Now, I don't know, that was just fun. Whatever. Sue me. Don't know where we got there, but anyway, any advice? Yeah. You're going to have to pay an accountant to sit down and do some detailed year-on-year assumptions. They may go back. Look, there is a detailed search function on ChatGPT. It might take an hour to search, but I think it's a manual thing.
The message is, though, that it is going to be quite detailed. It's going to take a long time. It's going to cost you a bit if you don't have these records because it is a long process.
150%. Stu, do you have to wait for your share platform's end-of-year statement for your tax return, or can you figure it out early? Well, 100%. If it's a platform like Superhero, Sharesies, Shares Direct, if you've got a wrap account, 100% you are, because that's why you have the platform, right?
Exactly. And, some of these distributions you receive throughout the year, part of it is tax-free. So if you were to just go and put the actual cash distributions you've received in your tax return, you're not actually reporting things correctly because you can be receiving, say, foreign investment income, you can receive dividend investment income. There may be franking credits attached to it. There may be capital gains, which are then subject to the CGT discounts that are available. So if you are using a platform, we tend to say wait until they come out, which usually is around the end of September. So if you're wanting to lodge your tax return before then, just hold off, just don't do it because we need to wait for those tax statements to come through.
Yeah, and within that, it's kind of the reason that you should just wait 10 minutes until after the financial year before doing your tax return. You could have your shares and ETFs on Superhero, for example. What if you've got BlackRock ETF, Vanguard ETF, you might have a VAP REIT, okay? You might have VAS. You might have some direct individual shares. You might have some State Street stuff. You might have some Global X stuff. The platform won't be able to give you your full tax consolidated statement until all of those individual ETFs have done their end-of-year statements. So it could be you might have one REIT, for example, that they're not sending a statement until 30th of October, and Superhero or insert platform is ready to go, but they can't because they can't plug in all the holdings to your report.
Exactly. And I suppose, if you are investing in these platforms, you're a bit more of a complicated person in a tax return space. You're not just got wages and salary or a bit of interest. You're actually doing something that's more complicated. And when you do that, there are implications. You are making more money, you are doing different things. That's just the outcome of having these investments. And I think it's just about accepting that you just can't do your tax return on the 5th of July if you have investments. And also too, if you have interest or individual shareholdings with your dividends, those things take time as well to log onto the tax office pre-fill report. Again, so if you're lodging very early in July, it's potential that you're going to miss some of this stuff and the tax office will cross-match and they'll send you an amended assessment. Could be 2 years down the track, but you'll get an amended assessment. So I would just hang off. Just sit tight for a hot little minute and then all the information will be there.
And I was just actually thinking, if you had Superhero, for example, and then on Superhero you had VAP, which is the Vanguard Australian Property Index Fund. For example, they've got a holding in Dexus and all these other REITs, because it's a REIT of REITs, basically. There could be one of the underlying REITs that Vanguard is waiting for details before Vanguard can do the statement. Then Vanguard can do the statement and then send to Superhero.
Again, how complicated is that? It's
Yeah.
not just a straightforward process. And I think that if you are investing in these type of platforms or these investments, you just need to accept that you need to wait for a moment.
Yep. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.